Welcome back, everybody. This week we are diving in with another investing topic, although it can also be considered trading. We're going to be talking about options. And this week is going to be more of a basics of options tutorial, kind of showing you what the different types of options are, how they're used for hedging, and how you can avoid risk in general using options. And then this is a multi-part series on options. So in the coming weeks, I'll be talking a little bit more in depth about the Greek letters and various strategies you can use for options as well. So hope you enjoyed this one, and I'll see you all next week. Welcome back, all you scholars out there. Today we are talking about options, and this is the introduction to options. Trading and investing in general in stock might not be everyone's cup of tea, as you might have noticed. Some prefer to post up less capital to make each dollar work harder for them. It can also work against you, though. And this is kind of the premise of why equity options came into existence. They've been around in some form or another for thousands of years. They're often used to lock in machinery prices to harvest crops in the springtime, when it was winter, and they would be paid for when the machinery was used in the spring. Options are also common in many financial settings. Some of these include the deployment of certain capital ventures and to lock in certain inventory items for future time periods. Usually futures contracts also play a role in securing input prices for production, so they're kind of similar in that sense. Options are a type of derivative, meaning their value is, as its name suggests, derived from the underlying security, and in this case it's going to be equities. So there's two types of options that we should be concerned about here. Call options, which is the right to buy, and put options, which is the right to sell. And notice that neither of these have the obligation to buy or sell. Every option contract has a pre-specified maturity when the option expires after this date, and they have a pre-specified strike price, which we'll talk about down below. After expiration, options are exercised where the option to buy for a call or to sell for a put are utilized if the holder so pleases. Again, they're not obligated to do this. The holder can buy for a call or sell for a put 100 shares of stock at the pre-specified strike price. So as standard, one option contract always represents 100 shares of the underlying stock. The strike price can be seen as the price that the holder of the option would like to buy or sell 100 shares at. So now we can take a look at a profit diagram to help us in this regard. So imagine an options trader would like to buy a call or a put option at a strike price of $150 on Apple stock. The current price is at $148, so the call is currently what's called out of the money. So now we can take a look at the profit diagram. So we'll start with the call option here. So on the y-axis we have the profit and the stock price on the horizontal axis. And we can label the strike price and the spot price. And we can see once the strike is hit, we start making money, but we pay for the option up front, so we start out with a negative value here. Similarly for the put option, we have the opposite here, so we're making money when the stock price is low, and as it rises, we start losing money, and eventually we lose that initial amount that we paid for the option, and at the strike, this levels off. Currently losing money at the current current stock price, and we're currently at break even for the put option. So when you hold a long call option, so you're long a call option, above the strike price is referred to as the option having intrinsic value. And you'll hear this a lot in finance. And this means it's in the money. Essentially it just means that your option is starting to become profitable. Similarly for a long put option, when we are below the strike price, this is considered in the money, and that's because we're betting on a bearish market. If the opposite is true, however, the option is called out of the money. This simply means that the option will expire worthless if the current conditions hold until maturity. So you would not want to buy at the strike if the stock price is below it for a call, or sell shares at a strike lower than the stock price if it's higher for a put. And this makes sense if you think about it. And when an option is at the money, it's exactly as it sounds. So this is where the strike and stock price are equal to each other. So minus the cost of the option and fees, this is the break-even point of the option. Many option maturities are available, making them suitable for all kinds of traders and investors. All options expire in weekly intervals on the Friday of that week that it expires, and they're usually exercised on the Saturday following. Many traders also choose to write or sell option contracts. This is a little bit more advanced, but it may be favorable if the option premiums are very high for calls and puts, usually when a stock is very volatile. We see this a lot on Tesla. A written call is kind of like a put option, but you write a new contract that someone else is buying from you. So you get the premium credited to your account, so you get it up front as a payment. A written put is very similar to a long call option, which is the opposite, and you can open a new put contract and get the premium up front from the person who buys the put contract from you. Written options are often coined naked options. You hear this a lot, naked call or naked put. Combination of options or option and stock positions can be great for both hedging risk in the market and providing extra income methods. So we'll cover these in the future, but here's some examples. There's a lot of different strategies here. So there's covered calls and protective puts, which are very common for income strategies. We have collars, vertical spreads, calendar spreads, condor spreads, straddles and strangles, which are good for earnings, and butterfly spreads. Options also have a set of Greek letters that provide various information about the contract in relation to the underlying stock. Some of these include things like theta, rho, vega, gamma, and delta, and we'll talk about these in a future video, and these are pretty complex. Options trade on their own exchange called the CBOE, or the Chicago Board Option Exchange. And liquidity of contracts can be an issue, especially if you're purchasing deep in or out of the money options. And that's because not many people are buying or selling these. So finding the right maturity strike and to select a call or put and whether to choose long or short is more of an art than a science. So traders have been combining these endlessly to find strategic money-making strategies for as long as options have been around, and it's still a big thing today. So see you guys next week.